According to tanker tracking data tracked by Bloomberg on Tuesday, Russian crude oil exports by sea in the first week of 2024 were in line with a level Moscow has promised to maintain as part of the OPEC+ agreement. According to data reported by Bloomberg's Julian, Russian crude oil shipments between January 1 and January 7 averaged 3.28 million barrels per day, BPD. This is precisely 300,000 BPD less than the observed exports by sea in May and June, which are used as reference levels for Russia's promised reduction of 300,000 BPD of crude exports. In a show of support for its OPEC+ partner Saudi Arabia, which is voluntarily reducing its oil production by 1 million BPD until the end of the first quarter of 2024, Russia had promised to reduce its oil exports by 300,000 BPD until the end of 2023. Russia announced that it would expand the export cut to 500,000 BPD in the first quarter of 2024 at the most recent OPEC+ meeting, which took place at the end of November. The reference export levels for the cut would be May and June 2023. This quarter's reduction will be made up of 200,000 BPD of refined products and 300,000 BPD of crude exports. Russia is holding up its end of the agreement, as evidenced by the first week of 2024, when average exports of 3.28 million BPD decreased by 500,000 BPD from the previous week to December 31 and by 300,000 BPD from May to June 2023. According to Bloomberg monitored data, Russia's crude exports in the 4 weeks leading up to January 7 averaged higher at 3.34 million BPD, or about 245,000 BPD less than the level in May and June. Even before its invasion of Ukraine, Moscow has consistently been evasive about its compliance with the OPEC+ agreement, so it's unclear if it will continue to keep exports at the current low level. Russian crude oil shipments may also be negatively impacted by problems with sales to India as the West tightens its enforcement of sanctions. According to the energy minister of the country that exports the most crude oil globally, Saudi Arabia is now seriously focusing on all forms of energy and fighting global warming. Saudi Energy Minister Prince Abdulaziz bin Salman made the following statement at a mining conference in Riyadh on Wednesday: "As a country, we are no longer called a leading oil-producing country. We would like to be called an energy-producing country, all kinds of energy." Reuters reported what Salman said. According to him, Saudi Arabia will keep producing fossil fuels while attempting to lower its emissions from them. People still have a desire to keep producing fossil fuels. But we also need to work on reducing our reliance on fossil fuels, and everyone should be doing the same, Prince Abdulaziz bin Salman continued. Prince Abdulaziz bin Salman told Bloomberg last month at the COP28 climate conference in Dubai that the kingdom would not support any resolution at the conference that calls for the phase down of fossil fuels. The Saudi minister declared that Saudi Arabia would absolutely not be pleased with the statement that fossil fuels should be phased down. After intense discussions about the use and production of fossil fuels for an additional day, 28 Colombian pesos came to a close with a compromise text that for the first time mentioned a call for all parties to move away from fossil fuels. However, the final agreement was weaker than any mention of gradually weaning off fossil fuels because of opposition from numerous oil-exporting nations, chiefly Saudi Arabia, which stalled negotiations in the last few days and forced the conference into overtime. Saudi Arabia and its state oil company, Aramco, have stated time and time again that lowering emissions should be the main topic of discussion in the energy sector rather than lowering the production of oil and gas. Aramco CEO Amin Nasser stated that the Saudi oil juggernaut is focusing on renewable energy, e-fuels, hydrogen, and carbon capture and storage, CCS, during a speech at the Energy Intelligence Forum in October. Yet he continued, "The world will need gas and oil for decades to come, and renewables won't be able to meet this need for decades." According to Nasser, new upstream investments are required to counteract the 5 to 7% annual decline rates in oil and gas demand that will arise over the next 10 years. Analysts predict that the three horsemen of low oil prices, oversupply, weak prices, and sluggish demand growth, will become the most likely scenario for this year. The state of affairs in the Red Sea is the only element that has the ability to counteract the effects of these factors. Oil prices, which saw their first annual loss since 2020, cautiously recovered during the first week of January due to ongoing Houthi attacks on Red Sea container ships. However, they continued to be cautious when it came to tankers, which are still freely traveling the Asia-Europe route. However, analysts don't anticipate benchmarks to do much, unless there is a significant disruption in supply. For example, Goldman Sachs claims that the unexpected increase in supply last year may persist this year, capping global prices. Sarah Kiernan, head of Goldman's Americas Commodities Sales, stated this week that the United States will continue to produce more oil, which surprised almost everyone last year. But it will grow more moderately, she added, pointing out that Brazil is producing more oil. The president of AOG Resources stated earlier this month that this year's growth in U.S. oil production will be less robust than last year's. Billy Helms said, "Bringing on a lot of production last year, you've got a steeper decline to offset this next year," during an investor event. That indicates that U.S. production will not be able to increase at the same rate as it did the previous year. Regarding demand, experts cited by the Financial Times mentioned ongoing concerns about the economy, which would moderate the demand for oil. But cheaper fuel would also mean cheaper oil, which would increase demand. According to a report released this week by Deloitte, West Texas Intermediate is expected to average $72 per barrel this year, which represents a 7% decrease from WTI's average for 2023, according to Bloomberg. The good news is that all of us are consumers in one way or another, and these lower prices will help us fill our cars and heat our homes, stated the national leader for oil, gas, and chemicals at Deloitte Canada. However, despite the drillers' new prudent approach to spending on growth, lower prices could lead to even slower growth in U.S. production. Drillers would be less likely to push horizontal drilling to its limits in the name of more supply if WTI trades were lower. At the same time, however, some allow for the possibility that U.S. oil production growth would continue strong this year, making life considerably harder for OPEC. Björn Schieldrop, chief commodities analyst at Swedish SEB, told the Financial Times that it will be much tougher for OPEC Plus if U.S. production continues to increase on a very strong note in 2024 on par with 2023. Especially if global oil demand is weak at the same time. In terms of OPEC, the cartel finds itself in a challenging situation. Reduced production of 2.2 million barrels per day would have resulted in much higher oil prices at any other time. But as of late, traders have mostly written off the cuts, focusing instead on U.S. output along with that of Guyana and Brazil, as well as on Chinese demand, which is predicted to decline this year. The risks to oil prices this year are pointing downward, according to Kiernan of Goldman Sachs. As Kiernan noted, the political tail upside risk is always present and highlighted by recent events like the Houthi attacks on shipping in the Red Sea. The fundamental supply/demand risks are still probably more skewed to the downside. People are keeping an eye on inventory balances when it comes to fundamentals, and the current curve shape does not indicate a tight market. This fundamental picture is what led to the decline in oil prices following Saudi Arabia's price cuts, which were perceived as an attempt by the kingdom to hold on to market share in a difficult environment. Overall, it seems that most analysts anticipate a quiet year for oil prices, one that has been described by the media as soft. But in early January, 2022 might have also been considered as a soft year for oil prices. Although traders appear to have largely written off the Israeli-Palestinian conflict as having no bearing on prices, analysts warn that there is always a chance of an escalation that would involve major producers, most notably Iran. Prices would undoubtedly be impacted by that. Regarding demand and its lackluster performance this year, all eyes are on China. The world's largest oil demand driver broke record after record last year, but traders were not happy with the weak growth in demand. This year, analysts anticipate a softening of demand, so expectations are likely to be moderated. China will purchase more, if only to fill its storage tanks, if prices stay low. If the correct circumstances are met, it has happened before and will happen again. Naturally, there's always a chance for something unexpected to happen and drive up oil prices. But for the time being, that likelihood is extremely slim. And that's it. If you want to continue to learn about business investing and financial education, we have got this video waiting on the screen for you to check out. Don't forget to give this video a like and subscribe for more videos like this. Thank you so much for watching, and I'll see you in the next one.